reason, we should dive into the reason the deals are actually slower. And a big part of that reason is the sellers don't have to sell. If the sellers had to sell, they would lower the price to where the buyer needs to be in order to get the deal done. But if they don't have to sell, then they're going to keep the price that they want. And then the buyer, it is a stretch right now for buyers with these rates and these prices to buy, but that's probably not going to change. And unless you have that seller distress, it's not going to change.
Yeah, and so let's look at why a seller would sell. Obviously, if they're Airbnb, if they're an investor, right? Let's say things aren't cash flowing, right? Because the rental market's soft for sure. If the loan's maturing, if they've been relocated, if they've lost their job, if they're retiring. So there's lots and lots and lots of reasons that, people want to leave an area. And what are they giving up? They're giving up that rate. So, but it's so in some cases they have to, in some cases it's a choice. And so you're always going to have that. But to Daniel's point, the rates need to come down a lot for millions and millions more that are sitting on these low mortgages.
So it's interesting that you brought that up, because I was just thinking of like all the houses that my clients are buying, or clients I have that are selling. It is almost always a distressed Airbnb, or it is a elderly person that is going to like an assisted living. Yeah. Or, we had one where the people were moving across the country, but like very few is, we just want a bigger house. Yeah. We just want a smaller house. Like even my, retired, people that are going to assisted living, like I haven't had any retirees that are downsizing. I haven't had anyone come to me or any of my clients buy a house where it's like, oh yeah, Joe's just, he's going to go buy a condo. He's living in this night. Like it's not happening. It's literally almost all people going to assisted living. That has been the main buyer pool that at least I've been working with.
Yeah. We have a friend that owns a single older woman, owns a, fairly big home. And, but she's got like a below 3% rate on it. Okay. And the home's too much for her, right? Just period. It is. It's just, she said so. Like the maintenance, the upkeep, you can imagine all that stuff, right? And so the right decision for her is to downsize into something smaller. It's more manageable, maybe in some kind of an HOA or something. And that's actually what she wants. But the lateral move actually makes her mortgage go up.
Yeah.
Like this is a really important point. Like, so she's sitting there with this really, really low mortgage rate and in a home that she actually knows she has a lot of equity in, but she knows if she makes a lateral move somewhere to something half the size, that her payment actually is going to go up. So it's a financially bad move for her. Mm-hmm. So she's staying put. And I think you guys got to really wrap your head around this. There's a tremendous amount of people in that situation. If they have floating debt or they're getting a divorce, or in Danielle's case, what she said with somebody moving into retirement, very different scenario. But the majority of Americans, a lot of them are just sitting on this really, really cheap money. And their cost of living is phenomenal. The lateral move, even to rental, is more, as you guys know.
Well, that's the thing. It's like, okay, somebody loses their job and they're stressed out about their mortgage payment. If you're in a rate that's 3%, your rent is going to be higher. So do you take out that equity, or do you just figure out,
right,
your situation, with the house? And it'd be interesting, those of you sitting in rates below 4%, for you to comment on the video and just say your situation, if you would ever sell, if you had to sell, why you had to sell, if if you're trying to sell but you're not going to move your price. I mean, all of that would be really good feedback, because I think people read the headlines, especially people that don't own anything, and they think, well, prices have to come down because I can't afford to buy and none of my friends can afford to buy, so like they have to come down. But the truth is, it really hinges more on the seller than it does on the buyer.
Yeah, and just before we wrap up, I there's a lot of studies out there, guys, on if you look at household formation, let's just focus on that for the last 10 or 15 years. We're at 16, 17 million. Okay, household formation literally means new households formed. Okay, population grew a lot. during that period of time, coming out of the GFC, not a lot was built. So there's like 8.5 million homes that were delivered during that period of time for all kinds of reasons, okay? Yes, post-GFC stuff, but also higher interest rates or whatever it might have been. But the supply never, ever kept up with the population demand. Okay, those are facts. So go take a look at the Harvard study. Go take a look at the Brookings study. Go take a look at Zillow, National Multi-Housing Council, National Home Builders. Go look at Realtor. Go look at all of them. Every single one has a report around all these metrics. And now, while they are all very different, I think that the ones that are not real estate folks, like Harvard and Brookings, are the ones that I kind of focus on. But even those show that we're about 3.8 million houses short. Even those. So now you might find some that say we're 5 or 6 million. You have some that say we're lower. But the reality is we're somewhere between 3 and 4 million houses short. Period. As a result of people and housing. Like, that's all you have to look at, right? So when you have more people, less housing, you're going to have prices that are going to be sitting there. Now, you're going to have pockets. You're going to have areas like we mentioned, like Austin, Texas is in horrible trouble. My business partner in our Limitless event, Limitless Expo, Toro, we just met last week to talk about our Limitless this year. And he's just going after Austin right now. He's going to buy hundreds of houses there this year because it's in a dip. Now, Austin is the capital of Texas. It's going to go through its thing. I bought in 2005. I caught below the dip, and then I rode it out, and it came back. So these cities, they have a life of their own. They grow, they contract, and so there's a time to buy and a time not to buy, time to exit, a time to cash flow, and all of that. And so there are cities. Florida has a bunch of them, and so you're going to, if somebody's talking about that, of course, if they're in that neighborhood and their home prices are crashing, of course, but outside of their little bubble, it's just not the case.
And I want to leave you with this because I really want you to sit on it and think about it. But 2008 was forced selling, and 2026 is hesitant buying. And those are very, very different markets.
Yeah.
All right. We'll see you guys next week. Don't forget to check out our podcast every Thursday. You can check us out on a podcasting platform or on YouTube.
Enjoy your week, guys.